Our new generation of youth is doing everything they were told to by their elders. They got educated, they work hard, they save what they can, but they're barely moving forward in building wealth. This chart tells you the story. Millennials, most of whom are already well into their 30s and even 40s, represent only a tiny portion of total wealth in the US. How do you think Gen Z will fare based on this chart? In this video, I'll show you, with numbers, why the playbook of the past decades doesn't produce the same results. This is Run the Math, where we simplify financial complexities for our viewers and help them make better life choices. Let's get into it. Rewind back about 40 years. You were a fresh graduate from university back in 1986. You would have an average median starting salary of $20,000. If you coupled up with another fresh graduate, you would have a joint gross income of $40,000. Assuming you were in a big city in the US, median home prices would range from $80,000 to $160,000 depending on the city. Let's take the midpoint of about $120,000. That would be a price to joint income ratio of 3 times. The down payment would cost $24,000 or 20%. The typical savings rate in 1986 was about 48% of gross income, after tax, before housing costs. In the US, most would move away from their family homes to big cities and have to rent. Let's assume this couple shared a decent one-bedroom apartment in a big city. At $500 per month, including utilities, they would spend about 15% of their joint pre-tax income on renting. That reduces their savings rate to still a very healthy 33% of gross income. They would be able to save for their down payment within 21 months. After buying their property, total housing cost in a big city would be about 40% of pre-tax income in 1986, including mortgage repayments, insurance, and maintenance. Renting was a lot cheaper back then due to high interest rates. Mortgage rates were at 10%. Their monthly cost in a purchase scenario will be estimated at about $1,300. That reduces their savings rate to about 8% of gross income. Not the best, but wait till you see the current day situation. Now let's look at a 2026 scenario. As a fresh graduate today in 2026, here's what you will face. You would have a median starting salary of about $64,000, a lot higher than 1986. If you coupled up with another fresh graduate, you would have a joint income of $128,000. Sounds rich, but let's run the math. In a big city in the US, median home prices would range from about $650,000 to $1.5 million depending on the city and area. Let's take $850,000. This isolates the outliers at the top end of the market while still catering for a family home. That would be a price to joint income ratio of 6.6 times, more than double the 1986 ratio. In the top cities like New York or San Francisco, this would be closer to 9 times. The down payment would be 20% or $170,000, maintaining roughly the same lifestyle as our previous calculation for 1986. Our savings rate now in 2026 of gross income after tax and before housing would collapse to 24% instead of 48%. Having 24% left of their gross income to spend on housing cost in a big city is going to be impossible. Before they even purchase their home, let's say this couple wants to rent a one-bedroom apartment in a big city. In line with our previous assumptions, we're not using top-tier numbers. Let's take an estimate of $3,500 per month, including utilities. This is enough to get you into a top city, but maybe not in a desirable neighborhood. At $42,000 annually, that would be 33% of the couple's joint income. They're not going to be able to afford it, as shown in this table. To even have a chance to rent and still save something, the couple would have to reduce their lifestyle expectations relative to their 1986 counterparts to achieve some savings. That entails increasing their savings rate to about 35% pre-housing to squeeze out at least a 2% savings rate of gross income post-housing. This is, in fact, the actual savings rate today in big cities. Why does our savings rate collapse if we try to maintain the same lifestyle? Let's break down the leakage. Some might argue that real incomes after considering inflation have grown. However, take note that the Consumer Price Index, or CPI, is an aggregate of a number of factors at certain weightages that hide the impact of categories that have far outpaced general inflation and wage growth, such as education and healthcare. Healthcare is a massive expense today with much higher premiums and co-pays than in 1986. Student debt is a new normal. Education cost has soared 535% in this period according to Fred data. While the 1986 graduate often had minimal or no debt, the 2026 graduate enters the workforce with mandatory monthly payments that instantly consume 5 to 10% of their gross income. Also relevant is that total effective taxes have increased from 20% to 23% as a percentage of gross income for most big cities. This is due to increases in local taxes and payroll taxes. Add these with some other estimated movements, and we have a total leak of about 24% assuming the same lifestyle from 1986. However, in reality, to make room for the much higher housing costs of today, people adjust by being more frugal, such as less dining out and deliveries, giving up owning a car, and reducing our discretionary spend. This helps to drive up our pre-housing savings rate to 35%. But even after all that, as mentioned earlier, 2% is the actual savings rate today in US big cities, while the national average is closer to 3% of gross income. But here's the real kicker. These percentages include older generations who have much smaller mortgages from the past, some of which have already been paid down. This group would have a much higher savings rate, pulling up the average. So, the actual savings rate of the new generation is more than likely to be close to zero or even negative. To cope with this situation, many downgrade their living space by having roommates or live in smaller studios, which we did not factor here. A 2% savings rate would take the couple 66 years to save for that $170,000 down payment to buy a home. Virtually impossible. But even if they were able to muster that down payment, assuming they received a gift from their rich parents, the housing cost for the $850,000 home purchase, including mortgage, taxes, and insurance, would be about $64,000 per year, or 50% of joint gross income, which is out of reach entirely. This clearly shows that to live a comfortable life, older generations simply had to graduate, get a job, work, and pay their dues. By today, they would have a handsome kitty of savings that would have rode the stock market to all-time highs, on top of having a fully paid-off property. Executing that same playbook today will get you nowhere, but there are even more factors impacting the new generation. Job stability is not what it used to be. The average tenure of employment has reduced by about 20 to 30%. This drop is even more pronounced for older age groups. Serial layoffs have become commonplace, with job cuts in 2025 exceeding 1.1 million, among the highest in the last few decades. You simply can no longer expect to stay in your job forever and expect a steady stream of income. More are turning towards the gig economy for employment, now approximately 36% of the US workforce, which provides far less benefits than full-time roles. Offshoring of jobs to low-cost countries is increasing as companies find cheaper alternatives. Roughly 20% of US companies are replacing outgoing US employees with offshore hiring. Economic volatility is now the new norm. Market cycles are shorter. Industries are getting disrupted faster than ever before. This means skill sets that we worked so hard to build may become irrelevant in a fraction of the time. Well, complaining doesn't solve anything. Let's talk solutions. I will outline some broad areas of thought that need to be considered. Trading time for money in a linear fashion does not work anymore. Employment is not inherently bad, but it is more risky. A well-thought-out career strategy is critical. De-risking through multiple streams of income is important. Do not subject your livelihood entirely to an employer's whims and fancies. Inflation is much worse than what is being portrayed. Real incomes may have increased over the last few decades, but I have laid out for you the reality. Assets appreciate much faster than employment income. If you do not find a way to ride on the value of asset appreciation by investing, you will fall behind. In my upcoming videos on this channel, I will be touching on a variety of topics dedicated to ensuring you are prepared for this new era. Side hustles. What business ideas work, don't work, are overused and overlooked? What do the economics look like? income, savings, and investments. The old playbooks don't work anymore. What does it cost to make certain decisions? Starting a family, buying versus renting, and moving to a lower-cost city. What does it really take to retire early in today's environment? Key movements in geopolitics and macroeconomics, an environment with reducing rates and stock market highs. What does it mean for you? My mission will be to run the math to empower you with the right knowledge to thrive in this new world. Subscribe for updates.